So can everyone see my screen? Good evening to everyone. Remember guys, if as we go along, if you have any questions, any queries, please drop it in the chat box. I will see your question, I will see your query. All right, so everyone's ready? Okay, so let's jump into this evening's class. All right, so this evening we're doing the volume price bar, and it basically is a show of strength. Okay, it doesn't matter if we're going up, if we're going down, the volume price bar is a show of strength. All right. Now, remember to check out the terms and conditions on the UOPFX website. Remember to read the disclaimer. Remember, we are not financial advisors. Everything we do here is for educational purposes only. All right. Now, let's jump into the volume price bar. The volume price bar basically marks the start of an impulse. It can be recognized by its long body with little or no wick. They appear at the end of a correction and start of a new impulse. How many of you know what an impulse is or what a correction is? Just give me by a show of just, yes, just send the I. All right, I see some eyes are coming in. Okay, so some of you know what an impulse is. Some of you know what a correction is. Wonderful. So that will make it a lot easier for you to identify a volume price bar. Okay. Now, we must remember that when we see a volume price bar, it can become an X wave. How many of you know what an X wave is? Give me a Y this time, if you know what an X wave is, or give me an X. That's better. Give me an X. So you guys know, Ryan says X and Y. So you guys know what an X wave is. Okay, wonderful. I'm happy to hear that. Great. Now, a volume price bar can lead to an X wave. It could also lead to a truncated wave. Give me a T if you know what a truncated wave is. All right. Any more T's? Anyone else knows what a truncated wave is? All right, so many of you don't know what a truncated wave is. Okay, that's understandable. A truncated wave is a short wave. It is a wave that is cut short. All right, now remember we did measured moves, market geometry, right? And in market geometry, we would measure wave 1 to predict the length of wave 5 in a 5-wave impulse move. So if there's a case where wave 5 is shorter than the length of wave 1, then we look at that as a truncation. Okay, so any wave that is shorter than, let's say if wave 5 is shorter than wave 1, we look at that as a truncation. If we have, let's say, a 3-wave move and the third wave is shorter than the first wave, we look at that as a truncation as well. Okay, and when we have truncated waves in situations like that, we can also look at it as ABC based on how it's constructed. All right. I see here. Ryan said, need to remind myself again. Okay, remember now. Got it. Wonderful, wonderful. So, Ryan, I refresh your memory. I'm happy about that. Okay, so now since we can find volume price bars leading to X waves and truncated waves, it is best to enter after the breakout of the correction that follows the volume price bar, right? So if the correction breaks the bottom of the volume price bar, let's say the volume price bar was a bullish bar, right? It was a green bar, bullish candle, and the correction comes and breaks the low of that bullish candle, then the volume price bar would have led to a X wave or a truncated wave. It could have also turned into the first leg of a correction. Okay, so remember that. Okay, so once that type of situation happens, we will have to trade accordingly. If we're looking to get into the trade after the volume price bar, if you're looking to go long on a green volume price bar, you would want to see in some cases, you look for a little pullback based on the time frame that you're in, or you look for a corrective formation and then you jump in on the breakout of that corrective formation. Or based on the time frame that you're on, you're looking for price to come back, pull back, then break the high of the volume price bar. Then you jump in to go long. Okay, since it's a green volume price bar. All right, everyone with me? All right. Audio is low. Let me see if I can turn that up. Okay, 1 second. Okay, I think I have the volume. Let me just check this out. It's turned right up. It's the loudest. Okay, it is set to the loudest. I'm sorry. Maybe it's just me. All right, so I'll try to speak up. Okay, and check the volume on your end as well, okay? Anyone else having low volume on their end? Anyone else? No? Okay. So check the volume on your end if you're having an issue. Okay, wonderful, wonderful. All right, so let's have a look at what a volume price bar looks like. Okay, so here you can see that, let's look at the green arrows first. So here you can see that this is a big green candle, small wick, big body. We have another one here. We have the body and the wick are almost the same, but you can see here that it has a decent sized body. Okay. Over here we have a big body. The wick is not too big, but we have a much bigger body in this case. So this is also a volume price bar. It shows it shows strength coming into the market to the upside. Over here, we have a nice volume price bar as well. And this is actually on the 4-hour time frame. You could also find these on lower time frames, but you need to understand what time frame your instrument is moving within, because some instruments move smoother on the 4-hour time frame, while we may have other instruments that move smoother on the 1-hour time frame. And some may move smoother on the 15-minute time frame. It all depends on how the instrument moves. Okay, slower instruments will be cleaner on higher time frames. Faster moving instruments, more volatile price action I'm speaking about, would be clearer on lower time frames. Okay, so keep that in mind. So here we have another volume price bar. And here you can see that we have a big candle It has a small wick, it has a small body. Sorry, it has a big wick. It has a small body in this case. We could also look at this one as a volume price bar. And why is that? Simply because this wick that we're looking at on a lower time frame is actually a big green bar. Okay, so that's also something that we need to pay attention to, these wicks, right? These wicks are also very important when looking at a volume price bar. So it's not just the body of the candle that we need to pay attention to based on the time frame that we're on. We need to also look at the wick of the candle. Okay, so a long wick on a lower time frame is a long green candle. Sorry, a long red candle. Okay. All right. So over here we have another volume price bar. This is a big red bar, and you can see we have the pullback. So on the breakout of that, you can actually go short. Okay. Here we have another one, big volume price bar. This shows a strength of selling pressure to the downside, and you look for the pullback based on what you expect the length of the wave to be. You can look for that pullback, and then when price breaks below, you can go short, or you wait for a corrective formation. This is the 4-hour time frame. So on a lower time frame, we could have found a correction to be able to go short. Okay. And as you can see here, another volume price bar, another one over here. We have another one over here. Okay. So would you guys be able to identify a volume price bar? Do you understand where these volume price bars show up? They show up at the end of a correction. They also show up at the end of an impulse. Okay, because volume price bars in a lot of cases would start off a correction, and they will start off an impulse wave. All right. So let's take it to our chart. I'll allow you guys to pick the chart that you would like to look at. So let me know what chart you would like to look at, and we'll look for some volume price bars. So go ahead and submit your charts in the chat box and look at any chart you like. All right, someone says S&P 500. All right, so S&P 500 it is. Let's see if I have a nice clean one on this layout. Okay, this one doesn't look too bad in terms of drawings. Let's look at the 1 hour time frame. 1 hour time frame doesn't look so bad either. Okay, let's go back. Let's just go back. I'm just gonna go back to a random time. Okay. Okay, so this is on Eastern Standard Time, my time zone. So generally, when you get into the market, you want to get into the market within the European session and the US session, and that's based on the instrument that you're looking at. Okay, with the S&P 500, I prefer to look at it through the European session into the US session. Okay, why is that? Because US traders, in a lot of cases, start trading from the European session. Okay, so the European session generally has a lot of volume. So let me just try to place a line to mark the start of the European session. So generally around 2 a.m. And I will generally stop trading around around let's see here, around 12 or so. That's generally where I would get out of the market, but in this case I'll try to mark 4 o'clock. Okay, so This is basically the piece of price action from the European session to the end of the US session. So this is basically um, 1 day of trading, right? Now, something that a lot of us need to pay attention to is when we get into the market. And for those of you who were present at our sniper entries class, you would understand. You need to pay attention at the time that you're looking to get into the market. Okay, so this was the 2 a.m. candle open. It closed at 3 a.m., right? So between 2 and 3 a.m., you're looking for your entry. So here, for those who understand the Elliott wave theory, we know that we're looking at a correction. We got 1, 2, 3, right? So this is potentially a corrective formation to the downside. And with this being a corrective formation to the downside, we are expecting price to move up. For those who understand how to draw a trend line, it should look something like this, right? So that is what your trend line looks like. So we're not interested in going short. We're only interested in going long. So you have between 2 a.m. to 3 a.m. So by 3 a.m., you're looking for an entry. And if you don't get an entry in the direction that you're looking forward to, you have from 3 a.m. to 4 a.m. to find an entry, right? So that's your initial entry that you're looking for. So you're looking at the 1 hour time frame when you're day trading. Based on the instrument that you're looking at, it is best to look at the 1 hour time frame. And I noticed that on most instruments, if you're looking to day trade, the 1 hour time frame is the best time frame to use. Okay. So here you have a big green candle in the direction that you are expecting the price to go. So on the close of this big green volume bar, you are looking to enter the market, right? So it closed, you had a little pullback. With you getting that pullback, if you want to go to lower time frames, let's see here. Let's see if I can find that again. One second. Let me just try to locate that piece of price action. Okay, here it is. Okay, so with me dropping down to the 15-minute time frame, I have multiple devices running, so sorry about that. Okay, the chart updated again, got me lost. Let me see if I can locate this one more time. Okay, I think I'm going too far. All right, or did they remove my lines? Okay, I'm gonna have to close out one of my. Okay, so I won't get that problem anymore. Let's go back to the 1 hour time frame and let's try to find where I was. Where was I? Anyway, we can start a little closer to the current price action. So let's start over, right? So we're gonna look for 2 a.m. I'm gonna use a horizontal line. sorry, a vertical line. Right, so 2 a.m. would be here. Okay, and I'm going to drop another one at 4 p.m. around here. Right, so what we're looking for is a big volume price bar between 2 to 3 a.m. and between 3 a.m. to 4 a.m. So that is around the time that we're going to see price move in the direction that we're looking for. Now, look at this. If you're looking at this type of price action, you can see that we have 1, 2, 3. This is a correction down. Now, this was a trend up. So if this is a correction down, we're expecting the price to go where? We're expecting the price to continue up, right? So we can see that we have a big push up. We have a correction here. And over here, we have a pullback. So let me just try to make this bigger. So within the time that we're looking to get into the market, we can see that we already have one leg down. And what I would do is create my potential formation that I'm looking for, which in this case is a flat. So if this is potentially a flat pattern formation, I will outline it like this, right? And as you can see, this is my first leg down, and I'm getting my first leg up at 2 a.m. Eastern Standard. So this is my volume price bar at 2 a.m. But I know that this was my first leg down, so this is my first wave up to create my B wave. So this is 1, 2, 3. Okay, so I could get in at this point because this wave could be a complete correction and price continues moving up. It could just be a sharp corrective formation. Generally not always the case, but this could be an early indication that we need to look for a reason to buy, right? So with us seeing this big volume price bar to the upside, which closed at 3 a.m., we just need to find a pullback. Now, if you understand the pattern formation that you're looking at, you know that we will expect one more wave down. And when that price comes back to the downside, we could enter on the completion of the correction, or you wait for a volume price bar, right? So the volume price bar that we're going to look at is this green bar right here. This green bar is coming in at 7 a.m. Okay, now on a lower time frame, your volume price bar might have been on the 6 a.m. candle. Like for example, if I drop down to, I don't want to drop down to the 15-minute time frame because it may just move the chart around too much. Okay, if we go down to a lower time frame, what could happen is we could see a big green bar right here on the wick of this candle, right? This red bar, we could have this wick being a big green candle, which is a volume price bar. So on a lower time frame, the volume price bar may come sooner. Okay. On the 1 hour time frame, we look at this candle as the volume price bar because the correction has ended, and this is the first green bar that we're going to see in the direction that we're looking for. It's a big green bar, big body, small wick. So we can accept this as a volume price bar. If it was a green candle with a long wick to the upside, a long wick below, we could say, okay, this is indeed a strong move to the upside because that long wick at the bottom of that green candle is signaling to us that we are in a big move to the upside. We're getting a lot of volume to the upside, and that's why we have a big wick at the bottom of that green candle, okay, or at the bottom of that red candle. All right. So if we did get into the trade at this time, you can see that the price continued moving up until we came towards the end of the day. Okay, and this is basically a good way to day trade. You need to understand that you need to get in around at the beginning of the wave. A lot of us are coming into the market around 8. So this is 8 o'clock. So we're coming into the market around here, and a lot of us miss, the move that is happening around that time because the move started earlier. So because the move started earlier, you may miss it. And if you came in and this candle closed off at 9 o'clock, you may not necessarily be too excited to get into the move because it is already late in the move. It's late in the day already. Some of us may be thinking that we're in the around the start of the US session. And because we're around the start of the US session, then it's a good place to get into the market. But really, it is better to get into the market at the beginning of a wave. Okay, you don't want to be entering halfway, because if you enter halfway, your stop is going to be all the way down here or all the way down here. Depends on where you want to place your stop. Some of us are placing our stops all the way down here. Okay, so you want to enter the market at a time when you're going to get your best entry, and you're also going to get the best opportunity to place your stop in an area that will be low risk. So if you entered on this green bar, your stop goes right here. Okay, if you wanted to put your stop lower, your stop goes right below this swing. Okay, so that gives you a better opportunity to protect your account or to protect your trade. Okay, so here you can see this move is coming to an end. And, for those of you who are looking to get into a trade, you're looking at around the market close if you want to trade the European session, but it is not wise to trade in the Asian session, sorry. It's not wise to trade in the Asian session. In the Asian session, what you can see is this type of price action. Price just goes flat, right? So all of this starts is in the Asian session. Price just goes flat until we have 2 a.m. again. And let me just put in a little line here. We just put in a little line here. So 2 a.m. There we have it. This is 2 a.m. And let's see, 1600 hours. Good. So this is the end of this session for this day, right? Now, if you understand the session times when you want to get into the market, this is 2 a.m. Right? This is a very small candle, 2 a.m. This one closed off at 3. And you're looking to get into the market. You need to understand what happened before this time, before the start of the European session. Now, before the start of the European session, what do we see? We can see price came down, 1, 2, and it is potentially going to make another move down. Because if you understand that price moves in 3 waves and 5 waves, you will be expecting another move down. So then this is just a correction. You can use a trend line. You can use a trend line to trend this. All right. So you expect some sort of 3-wave correction here. Now, what you're looking for to get into the market, you're looking to enter the market between the market open, which is, as I said, the close of the 3 a.m. candle. Sorry, the close of the 2 a.m. candle, which closes at 3 a.m., or the close of the 3 a.m. candle, which closes at 4 a.m. So around that time, you're looking to get into the market, right? So we have, this is the 3 a.m. closed at 4 a.m. So with this candle closing red, we know that this is a complete correction. We're looking at the next bar. The next bar is green. This one is basically from 4 a.m. It's going to close off at 5. So we're looking to enter on that green bar. The stop goes just below this red one. Okay, as you can see, this green bar comes, we get a correction. With us getting that correction, we can place a line just above this green bar, because this is our volume price bar. We look for the correction, we wait for price to break out of it. Price breaks out of it, price moves to the upside. Okay, and this is the start of the US session right here. So since this is now the start of the US session, this is another area where we can look to get involved in a trade. Now, if you understand price action, you would be looking at this high, and this would be what a lot of support and resistance traders would like to call resistance, right? So the price came up, it hits this resistance level, it comes down once more. Why is it coming down once more? It is coming down because this is 1, 2, 3. This is 1, 2, 3 down, right? So we have 1, 2, 3 down, 1, 2, 3 up. We're going to expect 1, 2, 3 down again. And this line, we just take a copy of it, we mark the low, right? So as you can see, we get one more move down, but at the end of this corrective wave, we have another volume price bar. This one is coming in from 9 to 10. So from 9 to 10, we have this volume price bar closing. And for those who would like to trade the impulse of this correction, you can try to take the last piece. I would not trade inside of a corrective formation when trying to trade one of the legs of the correction. In some cases, it all depends on the size of the corrections. If it's a very big corrective formation, then yes, I could try to trade the impulsive side of the corrective pattern, right? But generally, we're waiting for the start of the impulse, which is the best side of the market to be on. So here you can see this correction ended, and the time now shows um, it's like 1 o'clock, right? So generally, we want to get out of the market around midday. In some cases, we could get another move towards the end of the day, but generally, we want to get out of the market around 12 p.m. Eastern Standard. So by the close of this green bar, typically we would want to be actually by the close of this red bar, we would want to be out of the market, right? Because this red bar is closing at 12 p.m. Eastern Standard, which is the open of this green one, right? So around this time, you want to be out of the market. If you did enter on the close of this big red volume bar, we would be able to exit at around 12 p.m. Eastern Standard, which is on basically on the open of this green bar right here. Okay, but as I said, we don't really want to trade corrective formations unless they're big. If they're big, then yeah, it would give us a good opportunity to make some pips. But in cases like this where they're small, you want to make sure that you only go for the impulsive side of the market, which is we will go back to the upside. Okay, so this is another big volume price bar that's coming in here. But typically, as I said, we want to get into the market um, at strategic times. Okay, you want to get into the market around the session open in the European session. You want to get into the market around lunchtime in the European session, which is around 5, 6 a.m. Eastern Standard. And you want to also look for entries in the market around the US session open, which is 8 to 9 um, a.m. Eastern Standard. Okay, so these are the best times to look for entries, also very good times to look for exits in the market. Okay, any questions so far? Any questions, guys? All right, let's take a look at another instrument. Someone said US 30. Let's go over to US 30. All right, so we're on the 1 hour time frame on the US 30. This is a US instrument. So generally, we could look at this from the start of the European session as well, right? Because as I said, um, US traders like starting off their day in the European market. So once the instrument is open, in the European side of the world, then yes, you can look to get in around um, the start of the European session. So let's check. So in this case, we're not going to go very far. In this case, let's see, where's 2 a.m.? This is 2 a.m. Where is 16? Good. So in this case, you can see that we have one aggressive wave down, we have a pullback, and with us getting this pullback, we can expect either price would have continued up or given us another wave to the downside. Now, in a case like this, let's make this a little bigger. In a case like this, you can see that on the close of the 2 a.m. candle, we have price being flat at that time. So don't forget your trend lines. Just draw a horizontal line at the top of this sideways movement, and we can expect 1, 2, 3. At the end of the correction, you're looking for your volume price bar. This volume price bar is coming in at around 4, well, the close of the 4 a.m. candle. And as I said before, on a lower time frame, you could be getting a earlier entry. Okay, I prefer to use the 1 hour time frame on most instruments, especially when I'm looking to day trade, right? So on a lower time frame, you could have entered here because this is most likely a green candle on the lower time frame. Your stop could have gone just below the swing on the close of the bar. Okay, and you're going long, we're going long. Generally, we go long until we see an opposite candle. This red candle is coming in. In this case, it's coming in um, on the close of the 5 a.m. candle. So this could have been an indication telling us to get out of the trade because the price could have been coming back to the downside. But if we did get out on the close of this red bar, we are looking to put another line at the top. And if price breaks that line, you look to jump back into the trade to go long. And as you can see, our next exit, generally, we would be looking to exit uh, 1 second. Yeah, we would be looking to exit around 12 p.m. or so. But we also have the start of the US session. So we have the start of the US session, which is around 8 a.m. and 9 a.m. So at 8 to 9 a.m., we're looking at the candles. At 8 to 9, this is a green candle. And as you can see here, at 9 to 10, we have a big red bar. So in a case like this, if you get a big red bar, you would want to definitely exit any buys that you're in and go short. Uh, this wave to the upside, we could have also had, other reasons why we would want to close out this trade around the end of the wave. If you're using market geometry and you see that you get a measured move, which means you know that this wave should be a certain length. Once you make that length, you exit the trade right away. You get this big red volume price bar. It is coming in at 9 to 10 a.m. So opened at 9, closed at 10. This is a lovely trade to get involved with. Either you get in on the break of the low of the candle, or you wait for a nice correction on a lower time frame, like maybe 50 minutes or so, and then you look to go short. Okay, on the breakout of the corrective formation or on the breakout of the low of this red bar. Okay, and as you can see, you could have caught a nice trade to the downside, and we could have held this trade until we see um, the day came to an end. either the day came to an end by 12 p.m. Eastern Standard, we exit, or if you're looking to trade throughout the entire course of the day, you're looking for an exit at approximately 4 p.m. Eastern Standard. Okay, so this exit would have came in a little bit late, or you exit on the first green candle that you find. Now, in some cases, price could be a little bit choppy, but when we're dealing with impulse waves, in a lot of cases, we don't have a green bar until that wave is over or about to create a correction. Okay, so on the 1 hour time frame when you're day trading, the colors of the bars kind of do matter. So if you're in a sell trade, you see a green bar close, you need to get out, because what that can mean is you're getting a correction or the move is about to end. Okay. Any questions so far? All right. I see Norville says, can you compress the chart so that we can see resistance and support? Let's see. All right. So as it relates to resistance and support, right? A lot of traders look at resistance and support in many different ways. My view on resistance and support is within pattern formation. So then I would be doing something like this. I'm looking at this high and I'm looking at that. That is my resistance. Okay. My support, I'm looking at support. This is 1, 2, 3. This is the end of my wave. This is support, right? And I pull this into the future. See, this is my support. This is my resistance here. This is my support here. So this is a complete wave. This is a complete wave. Price is coming down. It is approaching the end of the wave to the downside. So once it hits this level, I'm looking to buy it back, right? Because this is a corrective formation. We have 1, 2, 3 down, 1, 2, 3 up, 1, 2, 3 down. We're going to expect another move to the upside. Okay. So you need to make sure that you pay attention to that and understand the wave pattern construction. Okay. All right. Anything else, Norville? Anyone else? All right. Let's see here. Let's see here. Any other chart you guys would like me to look at? All right. Okay. Wonderful. Wonderful. Let me see here. Okay, I see Sandrika was saying something about April 16th. What about April 16th? Oh, I think you were referencing where I was on the chart. Okay, okay. All right. All right, guys. So basically, if we understand our volume price bars, they could help us out a great deal. We need to understand that, you know, a corrective formation is a three-wave pattern formation in most cases. In some cases, we may find WXYXZ, which is a five-wave construction, but it still could be classed as a three-wave pattern formation if you know how to look at it. And once we understand our uh, corrective formations and impulse wave formations, we will be able to get in at the right time, looking at a volume price bar as a sign of confirmation that the price is going to go in our favor, especially coupled with session start times, session break times. These would make for a great um, composition of strategy to help us find success in the market. All right, I noticed I'm getting something in the Q&A. Okay. All right, guys, we're using the chat box. not the question and answer box. I see someone said XRP. So someone wants me to look at Ripple. Okay. Let's see what Ripple looks like. There you go. This is Ripple. Now the rules on crypto may be a little bit different. Okay. The rules on crypto may be a little bit different because if we're going to use sniper entry, the sniper entry technique on crypto, we need to understand when volume typically comes into the crypto market. And as you know, the crypto market does not have an open, does not have a close, right? So we need to understand who is in charge, which session is in charge of the crypto market. Now, I haven't really paid that much attention to it, but typically the crypto market is sometime after the US session. That's what we normally would see a lot of pressure coming into the crypto market. So as you can see here around, let's say, we have, if we look at the waves, they can help us out a lot. Okay, so here you can see that it's around the end of the day. This is around, let's see here, 2 a.m. So here we have some movement at 2 a.m. We have some movement back to the upside coming in around the end of the US session. So once you understand the various times that the volume is going to be coming into the market and you understand the pattern construction, you will know to look for the volume price bars. Okay, so for example, the price is coming down. If we, let's just look at this one wave to the downside, right? So the price is coming down. Just make sure it's not too small. Good, so the price is coming down, right? So for us to get into the market, we need a big volume price bar. So this is a big volume price bar. So if we knew that the wave to the upside ended in this area, then we know that, okay, this big red bar is our signal that sellers are coming into the market. We look at that big red bar as a volume price bar. Okay, what you can do, you wait for a little correction and then you can go short. You put your stop above the high. Okay, and you hold short for the length of the wave that you're expecting. Okay, when that wave is complete, you get out of your trade. You get a correction. We know that this is the impulsive corrective wave down. We get a correction. You can trend it. Trend the correction. So with you trending the correction, you will have an idea where you want to enter, because this could evolve and just become a bigger correction. So what you want to look for is the breakout, right, of this corrective formation. So with you seeing this type of pattern over here, this is where the price is sort of flagging at the trend line. That will give you the interpretation that you could be getting price getting ready to go down, because this is also a corrective formation for downside. This is a strong move down. This is a correction where we'll expect price to continue to the downside. Okay, this bar is coming in at 2000 hours. We could look at this as a volume price bar as well. With us seeing this big volume price bar, we will want to look to go short. So either you enter short on the breakout or you enter short, excuse me, on the break of the low of this red bar, or you wait for price to break out and correct and then you sell. Okay. And not in every case you're going to get price breaking out, then correcting, then giving you the opportunity to sell. In cases where you get the correction above the trend line, you want to sell the breakout. If you got price pushing below the trend line, then without a correction, then you will get a correction below the trend line, then you can go short. Okay. But remember the volume price bars, you're looking for big bodied candles, or you're looking for candles with um, small bodies but long wicks, because on a lower time frame it would show up as a big bodied candle. Okay, any questions, guys? Everyone knows what a volume price bar looks like. You guys can identify a volume price bar. All right, let's take a look at, someone mentioned euro dollar, US dollar. Here we go. Okay, so euro dollar, US dollar. This is a much easier one to look at in terms of if you want to look at the session times for sniper entries. Let's see here. Today was quite a mess on the euro dollar, US dollar pair because of the high impact news events that were coming out in this area. As you can see, the price is very spiky in this area over here, right? But let's try to look at a previous day. Let's start from around this area here. So let me just put in a vertical line. Let's try to mark 2 a.m. Good. And let's mark 12 p.m. Good. Because when I'm day trading forex, I will enter around 2 a.m. and I will stop all trading by 12 p.m. Eastern Standard. Okay. So by 12 p.m., I stop all trading. All right. Bella says sound is fading a bit. Okay, how is it now? Is it better? Maybe the connection is going back and forth. Okay, wonderful. Okay, so look at this. So here we have the 2 a.m. candle open. It closed green. Okay, so with this candle closing green, do we know where our correction is supposed to end? Let me just show you what I think this correction is. I think that what we're looking at is some sort of wedge triangle type formation, right? So we have one, one, two, three. We have this here. So this is more like a regular flat formation. Other traders may look at it and call it a pennant. Some may call it a wedge. Different traders would have different names for it, but it's a regular flat formation, right? So we have this regular flat formation inside here. I would measure this wave, measure that wave, project it at the end of the correction, and that gives me an idea where this wave is supposed to end. So I know that anyway towards the end of this measurement, this wave is supposed to expire. Okay, so it came down a little bit more and I got this nice green candle. And with me getting that nice green candle, I can say, okay, we have one, two, three waves down. I need to understand if I can expect another wave to the upside before I look to go long, right? And with this being three waves down, this was five waves up. We broke the low. With us breaking the low of this five wave move to the upside, I know that, okay, this is most likely just a corrective wave to the upside. So this was a corrective impulse up. With that being a corrective impulse up, or possibly um, the end of the wave to the upside, the entire wave to the upside, this could have been the end of it. So if it's not the end of it, it's just the first wave of a corrective formation. So price came down, broke the low. I will expect to get possibly this measurement coming back in the market at the end of the three wave move down. Okay, and as you can see, the price came back. We almost made that measurement. Okay, so let us look at this. right? So that's the wave I'm expecting, but I'm not going to hold the trade for the entire wave. I'm going to hold the trade until 12 p.m. Eastern Standard based on what is happening throughout the day. Okay, so if I entered on the close of this green bar, that's after I get a correction. Okay, so I see my nice correction or price breaks the high. So I would have entered when price broke the high to go long. My stop goes somewhere below the swing low, just below the price, the stop goes. So you can see here that price went sideways a bit, creating a correction, then moved up aggressively. Okay, with price moving up aggressively, by 12 p.m. Eastern Standard, we want to be out of the market, or if we get a red candle. So here you can see that we got a red candle coming in at, let's see here. So we have two. All right, so we have 2, 3, 4, 5, 6. 1 second. All right, so we have the 6 a.m. candle closing red. With us getting the 6 a.m. candle closing red, in a lot of cases, what we would do is exit any buy trade that we're in. Okay, so if we got triggered on the buy here, we exit the buy, all right, on the close of this red bar. So with us exiting the buy on the close of this red bar, we would now look for a new setup. Now, if the price continues back to the upside, breaks the high of this red bar or the swing, we will enter long again. Okay, so if price came, you had your order waiting up here, price came back, filled your order, you would have been able to catch this move to the upside. You exit again if you get a red candle coming in between um, 8 a.m. If you have a red candle at 8 a.m. to 9 a.m., so if you have one open at 8, close at 9, and it's red and you're in a long trade, you exit. If it opened at 9, closed at 10, it's a red candle, and you're in a long trade, you exit. If not, you will hold the trade until 12 p.m. Eastern Standard. So 12 p.m. Eastern Standard came in, you would definitely exit your trade, not get back in the market until around the next European session starts. Okay. Another thing that you can look at is your support and resistance levels. Okay. Now I know a lot of traders are using support and resistance, so you can try to use your support and resistance levels. This area here where you got a corrective formation is a support and resistance level. So whenever the price comes back into this zone, let me just try to outline this. So if we look at this here, right? Whenever the price comes back into that zone, you will tend to see price get choppy again, okay? Because that is where you have resistance in the market. In that zone, price is going to become very choppy. Okay? Any questions? No questions for me, guys? Go ahead, drop your questions in the chat box. All right, Mark says no questions. Anyone else? All right, Sandraka says volume candle is after correction. Yes, it's going to be after a correction, and it's going to be at the end of an impulse as well, right? So it can start a correction, it can start an impulse. Um, Ellery says, thank you for a clear explanation. You're most welcome, most welcome. All right. Okay, guys. Well, this will bring us to the end of this evening's class. Thank you so much for coming. It was a pleasure having you again. I will see you on our next class. Bye bye for now, guys. Have a wonderful evening.